goods has been actually contracting. It has been shrinking. The core sector has also grown very, very slow.
We are going to see some pullback as far as production levels are concerned to manage inventories because in these past 3 months we have seen a fairly negative sentiment as far as the rural consumption story is concerned.
Well, RBI has been raising rates consistently, which is basically working on a contraction of demand as a process of controlling inflation. But I think now time has come to kind of relax it, reduce about 100 basis points, improve the sentiments in the market. The demand for consumer goods, consumer durables, all that has to go up.
You're with We Mean Business on NDTV Profit. I'm Shweta. Rajpal. Kohli, clearly very disappointing industrial output numbers once again, highlighting the sharp slowdown in the economy. On the show today, we're asking, when will this trend reverse and will the Reserve Bank of India cut rates or not on Monday? Let me introduce our guests on the show today. We've got Mr. D Rathi, Group Executive President of the Aditya Birla Group, joining us, and also Sajjid Chinoy, India Economist of JP Morgan, Shubhada Rao, Chief Economist of Yes Bank, and Manish Wadhawan, MD and Head of Interest Rates Global Markets, HSBC India. Many thanks all of you for joining us. But first, let's take a look at the big news of the day. The industrial production growth rate slowing to just 0.1% in July due to a very poor show by the mining and capital goods as well as the manufacturing sectors. Ira Dugal does the number crunching for us.
There's no relief on the macro front. The markets may be looking good, but the macros most certainly, at least domestically, are not. Let's look at the industrial production numbers that came in today. They were a touch on the weaker side. You got 0.1%, so absolutely no growth in industrial output in the month of July. Slightly better than what you'd seen in June, but nevertheless flat is the way it showed up. Let's look at the comparisons as well. And if you look at it in comparison to expectations, the expectation was for 0.5% growth. You got 0.1. The June and July comparison looks better, but the only reason July IIP at 0.1 is looking better than the June number, which was negative 1.8%, is because of base effect. So the headline number has improved marginally, yes, but it's purely on account of what happened on the statistical side, which is the base effect. Let's look at the breakups and try and understand what's happening in different segments of the industry. If you look at that, manufacturing remains sluggish, negative 0.2% growth again on manufacturing. Mining, no improvement, negative 0.7% growth. Electricity is positive at 2.8%, but this time around, this is a month in which we saw power cuts, power issues, plus there's a very, very significant base effect to contend with as well. Let's look at the capital goods breakup as well. Capital goods consistently remain negative, negative 5% in this month. Last month, there was a very significant negative, but again, there are statistical factors at play. On a trend basis, nothing has changed. Capital goods output remains in degrowth mode, and that's a consequence of the investment activity or the lack of it. Consumer durables were weak this time with just 1.4% growth, but there was a strong negative base effect because last year, this month, you'd see 9% growth. Consumer non-durables at 0.1% is telling you that there's nothing great to cheer about in the consumption side of the economy either. Two other segments I want to quickly point out. That's the basic goods and the intermediate goods. Again, nothing to cheer about. 1.5% growth on basic goods, but intermediate is starting to become a worry as well. This will eventually reflect in final good output. So negative numbers there consistently are not good news as well. Look at it from a policy perspective. Does this do anything to change the policy trend? Well, not really, because what you've seen on the IIP side is a consistent amount of weakness, which is continuing. Nothing has changed for the better, and nothing has changed very dramatically for the worse. There's just been a grinding lower kind of trend, and degrowth in capital goods in particular is the biggest soft spot. That has not changed. Consumption is going to become important in the months ahead as you get to the festive season. You do want to see relatively stronger consumption growth. As of now, it seems to be sliding off just a touch, but it may not be enough to change the Reserve Bank of India's mind, because inflation numbers will remain key for the RBI. Friday, we get that particular print, but even if we get a softish print on inflation, action on Monday, next Monday, that is, from the RBI, still seems very, very unlikely. People are starting to build in action maybe in October or maybe closer to the end of the year.
All right, that was Ira Dugal with all those numbers. But let's try and discuss what those numbers really mean. And are we going to see the Reserve Bank actually cut rates or not? And how important is this industrial output data really? Sajjid, first to you. How bad are the numbers looking really?
You know, we live, Shweta, in an age of diminished expectations. I think there is now a growing consensus that industrial activity in India has been very weak and will be pretty weak going forward. So the headline number really didn't shake anybody. I think what was a bigger concern were the details. And the details, frankly, were even worse than a very tepid headline number for the following reason. For the last year or so, we've all known that investment activity is kind of ground to a halt. It was consumption growth that was driving headline GDP growth. And what we're seeing over the last 6 months really is that there is a sustained and quite significant slowdown in consumption. So if this trend persists and consumption growth continues to slow, I think then at some level you worry that the wheels could fall off of GDP growth. And interestingly, if you notice, it's really not consumer durables, at least in the IP data, that have been responsible for the slowdown. There's so much talk about motor vehicle sales, for example. Yes, that has slowed, but not as much as people fear. What's really slowed is consumer non-durables. And I think that's where stubbornly high inflation, both rural and urban, have perhaps done more damage to consumption than we'd care to admit. So for me, the biggest concern is unlikely the investment cycle picks up anytime soon. If consumption were to abate at this rate, then GDP growth could be even weaker than we expect.
India's #1 news app just got even better. Download NDTV's new app. Fully optimized for retina display. Full screen view. Faster response time. And Sudoku. NDTV's new iPad app. Download now.